Hey guys, what's going on? It's your favorite mortgage lender, Abdel Khawatmi, Paramount Residential Mortgage Group, with my team, the Mortgage Plugs. I hope everybody is having a great day. I wish everybody a happy holiday. I really wanted to touch base with us today on Tuesday Tips with your favorite lender, just kind of going over what are some of the things that is currently going on in the market. What are some of the things that we are going to anticipate heading into the new year? Obviously, today is winter solstice. It's going to be the shortest day and the longest night. The rebirth of Christ, obviously going into Christmas, is some of the things that we celebrate. But we met earlier this month and we went over a lot of different changes of what we have currently going on within the market with the Fed, tapering, inflation, and everything going on. A lot of changes that are slowly happening within housing that's working out to our benefit, but simultaneously a lot of different adjustments that we're starting to notice is starting to transition. And the one thing that we keep running into recently, and we keep hearing that word being thrown around, is inflation. What is inflation? So we're going to go over a lot of detailed statistics and kind of touch base a lot of different avenues that I feel like is slowly causing interest rates to start increasing from the Fed meeting and the likes. So the wholesale price index market actually increased. The percentage of increase rose almost 0.8% in the past month that just passed in November. Curious to see where it ends into December, but inflation rates are going up. We're seeing significant avenues from continuous supply chain management to interest rates, mortgage bonds, and treasury yields as well. The stock market, if anybody has any money invested in stocks, obviously, I'm sure you guys are probably upset. There's been a lot of different adjustments with the S&P and a lot of different drops continuously as the market closes. Thursday, obviously, is going to be a half day for the market, and then Friday, it's entirely closed. So really no signs of inflation slowing down. There is obviously the retail market is going to start seeing. October was a great retail market. November kind of slowed down. And then, of course, December with Christmas, we're going to see. Now, inflation is the arch enemy of fixed pricing, which literally affects mortgage bonds, which thereafter goes into the buying power ability for mortgage bonds fixed rates. Investors are obviously very cautious when it comes to inflation, and they usually demand a rate of return to combat these faster erosions due to inflation. Now, the Fed, which we're going to discuss in a few minutes, obviously don't want to increase interest rates immediately while we're still purchasing mortgage bonds. They announced that they're going to start tapering, which we're going to go over in a few seconds, what that basically means when they first announced it back in their November meeting. Now, inflation on a horizon, think about it from a big picture perspective. Gas prices from inflation have actually increased by almost 58%. Obviously, those of us who commute to work or commute to various avenues have noticed that significantly. Food has gone up almost 6.1%. Used cars has jumped up almost 31%. And then gas utilities, obviously on our day-to-day, has jumped up almost 25%, with electricity jumping up about 6.5%. A lot of different studies are showing this is obviously one of the highest inflation rates that we've seen in almost 40 years. So really interesting to see a lot of the different avenues of how that's going to slowly start affecting the market, not just from the real estate, but also from a regular day-to-day. So with that being said, we're starting to once again see inflation impact retail sales, as we said in November. Although it wasn't significant in November, it was about modest of about 0.8%. We're seeing a slight gain right now into October of about 0.1%. And we're going to dive into right now some of the statistics in reference to low employment, along with additional statistics of higher than average rising wages, stimulus payments. We also have construction, which is a big one, and then also jobless claims and what's going on in that avenue. So, but picking back a little bit is in regards to tapering. So back in November, as most of you guys have seen, I've discussed before, the Fed announced that they were going to start tapering. Well, they said in the beginning, back in November 3rd, they're going to start tapering at about 15 million per year, that they were basically buying almost $120 billion in mortgage bonds and treasury yields. Well, last week, the Fed actually said, hey, we are going to start tapering, but we're not going to wait and do it only at 15 billion and wait till July, August, by the time we reach that 120 billion threshold. We're actually going to speed things up, and we're going to bump up almost double of the amount of what we're going to be tapering. So they're going to be doubling up the size of tapering for mortgage bonds from 15 billion to 30 billion. What does that mean? That basically means that if we were to do the math statistically, by around March to April, mortgage bonds are going to be completely back to where they were at before in reference to the tapering perspective, and the Fed is likely going to increase the benchmark rate as we get into the end of the tapering market. So why are they basically doing this? Again, the Fed wants to go ahead and increase. They're not going to do it overnight, borrowing from banks, because that's going to create a huge turmoil. What they're going to do is sooner rather than later, they're looking to speeding up the purchases of their tapering market in order to create outright purchases from the beginning, bringing it closer to zero, because right now we're at about a $9 trillion debt ceiling. And this is probably one of the major ones that are slowly starting to create a little consumer confidence. But at the same time, we're looking to see the slowly affiliation of hiking of the Fed rate, which we'll probably see. And hiking of the Fed rate is not a bad thing. They're going to increase the Fed rate, which is likely going to curb and slow down this inflation ratio of what we've been seeing. So now diving into where we're at with levels of appreciation. Home appreciations has definitely not decreased. It's slowed down, where the national home appreciation in November actually was at 15% down, which is down just literally a month ago in October of 16.1. But again, it's still statistically a lot higher, where we saw basically back in January of 2020, home appreciation levels were at about 6-8%. And then, of course, within the last year, they've skyrocketed to almost 18-19%. So again, they're not slowing down. So what does that basically mean? The price of you buy a home right now does not necessarily mean that by next year or 2 years or 3 years or 5 years, it's going to drop. It just basically means that it's not going to increase at the same level of appreciation of what we were seeing. From January 2013 to around January of 2019, we were always at that average of 6% to 8% in home price appreciation year over year. So that's a big number to think about. Home prices were still appreciating between 6 to 8%, obviously with the very short supply of what we're seeing in homes over the last year or so. That's one of the major reasons why appreciation levels have skyrocketed, of course, on top of consumer demand. Now, another big one is interest rates significantly dropped, of course, because of the pandemic with COVID, which simultaneously allowed the high demand to go on top, and subsequently short supply of homes, where a lot of sellers were not putting their homes on the market as much as they are doing it right now. Now, diving into rental. Now, let's remember, just because home prices go up, interest rates are down, that's not necessarily a bad thing. Your mortgage payment can statistically be proven, and you guys have seen probably a million different graphs, where if your home price is at $300,000 and your interest rate is at 3%, it is almost the same payment, if not less, than if you're buying a $350,000 home with a 4% interest rate. Okay. So now considering into rental report recently came out with another reputable source that actually showed that rent is set to increase almost 20% year to year from where they were last year into this year. So you're noticing a common trend, right? Home price appreciation jumped up almost, as I mentioned, 18%, 17% from last year into this year. Simultaneously, you're going to see rent start to jump up and increase almost 20% in the month of November coming into it now. So what does that basically mean? Is it better for you to buy or rent? It's probably one of the $1 million questions people ask me. You have to ask yourself that question is, if you're looking to stay in the home for quite some time, if you have a solid job, if you have some money saved up, in my personal and professional opinion, it obviously makes better sense for you to stick with a fixed payment that will never change. If you have a 30-year fixed or a 15-year fixed mortgage, your rent is likely to increase, and we're going to see very heightened increases, almost $300 a month from where they were last year for an average person who's currently going to be renting. Now, inflation again and expenditures, we're also going to see the forecast of 2022 with inflation jumping up again, another 2.3% to 2.6% of what a lot of different forecasters professionals say. Now, the housing market index right now currently nationally is at a number of 84. It's usually based off of a number of 0 to 100. Anything over 50% of a national market index, meaning that we're in a very good economy. And, let's not be wrong. The economy is strong. The economy is slowly starting to get back on its feet. We're starting to see, despite inflation levels starting to increase and the ongoing what's called bottlenecks of builders facing, we're still seeing a very high demand for homes way across the country, even with interest rates starting to go up. We're having a record fourth quarter, and we're starting to see a lot of different continued strength within the housing market way across the country, which is going to combat a lot of different housing supply shortages, as I'm starting to see this ongoing demand consistently of homes is going to start strengthening a lot of these different tighter supplies of what we're having within these home prices. And then when we think of constructions, when we actually look at constructions in regards to permits, there was actually an increase of almost 0.9% of just over 1.12 million applications for permits. We saw about 1.67 million in regards to the start, and then simultaneously we saw the completion in reference to almost 1.2 million. So again, one of the biggest takeaways is that although we're starting to see a lot of backlogs of home, they're starting to grow, and builders are starting to have a little bit more confidence in regards to starting to get out a lot more homes and get them started and completed. Now, diving into the jobs, the job market claim is obviously something that's going to slowly start going up and down with a lot of jobless claims. So the number of people that actually just filed for unemployment for the first time ever actually just increased by 18,000. So we have a total of about 206,000 initial jobless claims. Again, the figure, though, no matter how you look at it, once again, is the lowest that it's been reading in almost 52 years. So we're going to start seeing a higher bounce with continuing claims that are slowly going to start decreasing, which we've seen by almost 152,000 jobs to just about 1.85 million in total. Once again, pandemic era lows, which we're going to continuously start seeing. Now, there's just about 5 million people in total in the United States that are currently receiving benefits, which once again is a very, very healthy number if we start looking at it, contrasting it over a 20 million mark. So the last thing that I want to touch on is in regards to manufacturing activity. We're starting to see a rise, which is slowly going to start combating inflation and leveling off that high level of inflation of what we're seeing. Okay. So leaving you guys off with this is, what are we going to expect heading into 2022? So the major things of what we're going to head into is we're going to look at inflation. Inflation is obviously going to be a big key role as to what it's going to impact in regards to the housing decision for 2022. Rising prices, again, we went over appreciation levels are going to slow down from the teens to about 8 or 9%. But in my opinion, we're still going to be saving a lot of housing costs. Interest rates are still fairly low comparative historically than what they were within the last 40, 50 years. Buyers are still going to start seeing the cost of a long-term mortgage, and this is the best part, may outweigh the cost of renting. And as rents continue to rise and mortgage rates continue to stay low, likely makes better sense for you to save that money for a down payment and buy as opposed to rent. The next shift is obviously in regards to people working from home, remote work. This has been one of the major roles of coronavirus. Is it has showed how many different employers, because of the pandemic, have the ability to actually continue their employments working from home. Buyers who actually no longer have that daily commute to work have that freedom to work from wherever. So we're starting to see a lot of different scenarios where a consumer might work, let's say in the state of New Jersey, but wants to buy an owner-occupied home in Pennsylvania, or let's say Florida or the surrounding tri-states. So that actually can now change with people working from home remotely. What that basically means now is, depending on your workplace policy, you can live owner-occupied in a completely different state and simultaneously have that ability to buy an owner-occupied home working remotely. And then last is, of course, affordability. We're going to start seeing, again, affordability. Home prices are not slowing down. They're going up. Interest rates, though, as we said, they're going to start increasing with the Fed. That's 100% without our control. And it's not a bad thing, because it's being used in an effort to combat this inflation ratio and the emphasis on affordable living. What does that basically mean? It means that buyers' demand will likely end up start getting curbed a little bit, with sellers start getting out of the driver's seat and buyers slowly start diving into it as well. So a lot going on. If you guys have any questions, I want to leave you guys off with this. I want to wish everybody a happy holidays, Merry Christmas, Happy Kwanzaa, Happy Hanukkah, whatever holiday you guys celebrate. I appreciate you guys jumping on. As always, I will share my PowerPoints. Feel free to message me directly. Contact my team and I. 2021 was a great year. Definitely looking forward to a fun 2022. And I look forward to catching you guys soon. Have a blessed day.